It's time for Macro Monday, where the city's heartbeat meets the global economy. From Wall Street to the West Side, we track future interest rate moves, credit spreads, and national market shifts that shape New York City real estate. Fast, focused, and data-driven. Macro Monday starts now.
I remembered this time. There we go. All right.
Good morning, everybody. Good morning to you, John Walkup. Good morning, John.
What's happening, Noah?
Oh, not much, man. It is Monday. Good little Macro Monday, right? Good little Macro Monday coming right to you guys. Let's just start officially. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and it's Monday. So you're going to get a little Macro Monday coming right at you. For those of you that are new to this show, we're going to start out with Manhattan real estate, check in on the monthlies, see where we're at, where we're supposed to be, and then we're going to go to little macro items on the show. I got a couple things to talk about. We'll look at credit spreads very briefly, check in on interest rates, and then we'll circle back to Manhattan, and we'll try to do this all in 30 minutes or less, okay? Nothing that we discuss here is financial advice. Don't start day trading this stuff.
Well, the problem, though, is some of it is financial advice, but it's only in hindsight that it's financial advice. It's only like 3 months later, like, that was a great
we should have
call.
done this. Oh, that's a good point.
Could have, should have, would.
Always point out your winners. Ignore your losers.
You just have to have your time machine set perfectly. Then it's perfect.
I hear you.
Otherwise, don't do it.
Or have that book from Back to the Future, that gambling book, you know, that almanac.
Book. That's right.
Yeah, the sports almanac. That's right. That's what I'm talking about. Where was I? All right. Well, anyway, there's chats and there's comments. I don't know. There's some people commenting already, but we got some chat. If you guys have questions about anything we're talking about, or just want to have some fun, talk about something, put it right in the comment right over there. Yeah. We welcome questions. We're going to start. Okay, guys. I am on the market ticker. Look, let me show you how this works. Okay. Scroll down over here. Market ticker, dashboard, market snapshot, supply 659. This is going down. This is taking the elevator down. Okay, taking the elevator down for the season. That's supposed to be at 596. So, you know, next week and a half, not much is going to happen. You'll get some listings coming on, but very low. So,
yeah, there's definitely going to be something, right? You'll still get some listings coming on. You'll still get some price cuts here and there. There will probably be open houses here and there. I mean,
oh yeah, yeah.
It was probably a decent. I don't know. I don't know if you guys had open houses over the weekend. I did. So usually I check and see if there's anything here around, like what's going on. But it was snowing, so I didn't think about it. But then the sun came out, and it was great because you had the sun coming down, and then it was bouncing right off the snow, so it was very bright. So hopefully, if you had a darker place, you got a little extra light. So fingers crossed if you had an open house this weekend and you
needed the dopamine hitting the system. Everyone's in a little better mood, kind of thing. Yeah, I hear you.
Yeah, I could use my ski goggles on the street. It was very bright.
I'm hearing anecdotally that this market is starting to pick up a little bit as we end the year. I don't know if you guys are experiencing the same thing. You know, I like to call this pipeline activity because they got to name everything over here at UrbanDigs. But I mean, you brokers, I don't know if you're not brokers listening in, we welcome everyone, all kinds, but the brokers that are listening in, you guys are real boots on the ground, right? You guys are 2 to 3 weeks ahead of us because we're reporting on contracts, right? Contracts signed. These 7 that were signed yesterday, these 7 contracts have been in the works for 2 or 3 weeks, right? That's pipeline activity. I'm hearing anecdotally, take it for what it's worth, that there's some good activity going on. So I wonder, so like if I click on a week here, look, this is a month, 746 a month, it's supposed to be at 774. We're at 746. If I click on a week, see that's ticking up and that's at 217. That's a good number.
That's a good number.
That's a good number. So that's what I think I'm hearing anecdotally. So the question is, does that continue for the next couple of weeks? I don't know. We'll see. Just where you guys can comment right now and tell me whether or not you guys are feeling all of this.
I'm just gonna not comment, just leave you hanging right there.
Oh, okay, thank you very much. Yeah, it's a big pickle. All right, guys, look at the bottom right of the chart. Look at the bottom right of the chart. We've discussed a point that we want to get across to you guys. That's liquidity. That's what we just experienced. The market has decelerated since right after the election, and we're now down here, but we're not falling anymore.
Well, hang on. After Thanksgiving.
Yes.
Not the election.
What did I say?
You said the election.
I said the election.
Election was early November.
Thanksgiving.
Yeah.
Okay.
Yeah,
so there's the election, and there's Thanksgiving. It's close though.
It's close.
It's close.
But
We're nitpicking. All right. Anyway, we stopped going down. We're going down, and we stopped. So that's something. And again, I'm seeing this weekly bump. I'm hearing this thing. So I'm like, all right. So maybe we'll be okay. Right now, I want to make a point across. Okay, let's go to price action, guys. I want to show you price action. Right. I figured to show two things. Right. Price action. When you look at price action and you're looking at these closed sales that are at the very right end of the chart. Can I highlight this? That.
I got to put my glasses on to see that. How over it again? I guess I can't. I just can't see that.
Right over there. Right over there.
All
okay,
right.
Outlined it. Right there. Right there.
Right.
There's two little. Okay. So this is what we're experiencing, right? So my question to you guys is this data, this closed sales data, okay, bear with me. This closed sales data, okay, this is liquidity. We just talked about this. We stopped going down. The closed sales data is representing the moment in time that is outlined by this orange box. Okay, let's go back. This closed sales data right here.
What's the count? That's what I was like. If you go back, if you highlight, you could see the count of how many sales that is, just out of curiosity.
I see what you're saying. There's 248 in the November bucket, and there's 334. It's not nothing.
It's not nothing. No, that's a decent number. That's a decent number.
Decent chunk. Right. And the point is, guys, is that that's reporting on this down wave in activity. So when we think about price action, we think about where this is going over the next couple of months, it's going to start to represent that green box that I just outlined. And you got a wave. It's going to go up and then it's going to go down, most likely to reflect where we are today. And I thought I'd do a drawing, Johnny. That's
yeah, I think that's great.
Well, you know my name is Simon, and I like to do drawings.
We only rehearsed this like 3 times. No, it's like, here's how it goes. I'm gonna start drawing, and you got to put the Simon up there. I was like, okay, no problem. I'll totally remember that.
We had a side bet whether or not who's gonna remember it or not.
I won.
It's nice to see Simon before the year's over. Thank you, Johnny, and thank you, Simon. So I wanted to make that point across, guys. All right, this is the wave. We have yet to see that up wave. That's going to play through, and then we're going to have this little down move that we had over the last 3.5 weeks thus far. Okay? That's the update. We're now going to pivot.
Yeah.
Sorry, guys. We're having a little fun. It is holiday spirit. We're going to pivot to the macro portion of the program. That means credit spreads, guys. Credit spreads are a canary in the coal mine. If this blue line goes up, that is bad. If the blue line goes down, risk on. Stock market can continue to keep going up. Nothing really there that's going to trigger any other things in the credit markets. Going to trigger something crazy risk off thing. No, that's not what's going on right here, guys. This is going down. This is the 1 month going down. There's the 6 month. From a 6 month basis, we're right in the middle. From a 1 year basis, we're just kind of down. You could see the Liberation Day. So I don't see anything here. No news. Nothing to see here.
No, this is nothing to see here. And if we had a GIF from Naked Gun with the fireworks explosion in the background, I would click it and play it, because that I would remember. Nothing to see.
We need more short clips here.
We need. This is really all we need. Is what we want to do. Basically, is spend a half hour of your time playing clips of shows and movies, with interspersed with some decent knowledge about the market. But yeah, I mean, you look at credit spreads. There's really nothing happening, which is a great thing. Speaking of the economy, like that's what you want to see. You really want to see grass grow, just like nothing happening. So
there's no reason, there's no trigger that's going on right now to just cause a anything other than people looking to get a yield on their investments. Okay, so that's risk. Let me get rid of this phone call. Risk on until it's not. And you can see here, Financial Times also reporting, this is going around financial Twitter, how tight and how narrow credit spreads are. This is why we talk about this, right? This is driving things. So there you go. Risk on. Rates, Jason. We just did rates, John. I mean, we just did it. I mean, we just had a rate cut. Is what I meant. We just had a rate. We just had a rate move, rate cut. We do rates every week. I get confused. I mean, we were here, and now let me just draw this out. Now we're here. Okay, so we were up this level, and we moved a quarter point with the last cut, and now we're here, and I see no cut. We stay right here. Stay right there. January, stay right there in March. The next move, 43.7%, is April. Far out, under 50%. I think the takeaway that I see here, guys, and John, I'm curious. Let me just rewind this because I want to draw something out here. The takeaway that I see here is look where this is and look where this is. Okay, look at those two areas right over there where neutral is like right in the middle there. See that? Look, you draw a line right in the middle kind of thing. That's like 325 to 325. Somewhere in between these two boxes is where this is going to probably end up and just stay there for a while.
Yeah, I know this prediction of Fed funds rates here set by the traders is about as boring as you could get. I mean, it looks like it's penciled in.
But that's good though. Boring is good though.
Well, it's going all the way through 2027, which to me suggests that we're clearly toward the end of the easing cycle, and no one quite knows what the next cycle is going to be, so they're just playing it close. So expect the unexpected is what I would say for this, but I think right now you're pretty safe to say you're with your neutral line. That's a good point in terms of where we're most likely going to be. But the key is, how does this affect mortgage rates? And as we know, the mortgage rates are typically priced off the 10-year. So what has the 10-year done since rates have gone from whatever it was 5% all the way down? They've kind of gone up. Well, they've gone up, but the 10-year basically hasn't really moved over this whole period. So it's going to be interesting to see if we do get down to the neutral rate you're talking about. If the 10-year finally does, it just has to go down just a little bit to kind of pull those mortgage rates down a bit. You talked earlier about how the credit spreads are tightest than they've been in decades. That's a good thing because right now there's a lot of premium basically baked into the mortgages. So if we can get some of that to come off, we could have mortgage rates a little bit lower than even what the neutral rate would suggest they could be. So hopefully that means below 6%. But again, that's a New Year's thing, and we'll have to revisit that, come time.
Yeah, that's interesting. But I also think that if I'm a buyer and I think rates are going to go this way or that way, I may not make a move. I guess if I thought they were going up, I'd probably want to make a move sooner. But if they were going to go down, I probably would want to pause or maybe even delay. If I thought that mortgage rates weren't going anywhere, that whole thought process is just kind of not in the mindset. It's just out.
Yeah, I like stable environments because I think they're easier to make a decision because it just removes one layer of uncertainty. Even if it's, well, I'm going to wait because mortgage rates are going to go down, or I'm going to wait because I don't know what's happening. It's just like, no, look, we have a very clear timeline as to what they're going to be like. That's one less thing you have to worry about. That's a good thing for a buyer. So of course we're talking in a market where most of these sales are still cash. So, but I'd like to see the mortgage market light up on fire again.
We got a visual on that. We'll get there in a second. All right, here's what you guys need to know. We are here. No moves for the next 2 months. Next move is April. That's all you need to know, guys. The next move is slated to be April. It is 43.7%. We are not confident at all in that move. It may not even happen. You can see this is all consolidating about a half a point away from we are now. And I have this other screenshot that's going around Bloomberg. Take a look at this right side. They call it basis points, right? 50 basis points is a half a point. Okay, that's what this is. 50 is a half a point. And you could see what the latest dot plot is and what 2026 is pricing. It's basically putting us down to that 50, which is exactly what we're trying to tell you here. It's like 50 is right in the middle there somewhere. Okay, it's just a different way of looking at it. This is priced in. So when I look at mortgage rates right now, it almost looks like it's stuck in a channel. Can I draw on this? Yeah. No, I can't. But it looks like look, you see my arrow? I guess you can't see my arrow. This is like a channel on the side. It's just going sideways. Then you got a down channel over here, and it looks like we're just in another sideways. We've settled, built a little house down here. We're just going up and down in there, kind of thing.
Yeah, and which is interesting because we just had a half a point or a 25 basis point cut, quarter point cut, and what happened with mortgage rates? I mean, they're still in that sideways channel. So again, that you really have to start looking at the other things that make up that rate besides the 10-year, because that's where most of your cuts are going to come from in terms of that mortgage rate.
Yeah. I like this comment. I wish I saw it early when it came out. Some single name CDS like Oracle and other AI names are under pressure. CDS, credit default swaps. If you guys do not know credit default swaps, think the great financial crisis. Let's just go back to credit spreads. Think this big, that's credit default swaps. All right. And other mortgage-backed securities and other things like that. That's what causes that. The answer to that question is yes. Oracle is starting to see their cost of protection against a credit event go up, which is not a good sign. That's the credit market doing its thing. I'm not yet seeing that bleed into the broader credit market sector. And you don't know if that's going to even amount to anything. I've seen companies go up with CDS and go up and then go back down again. So we don't know if that's going to trigger any kind of systemic thing, or if it might be isolated in a couple of different areas. But that is what's going on in the AI and software world. It'll be interesting to watch. Okay.
Yeah. Well, it opens. Look, I mean, usually the way it's like to be, the way that people like to portray it is that the credit, the fixed income money is the bond money is the smart money, and then the stocks is just the fast, get rich quick money. So when you think about it from that perspective, the idea is that maybe there's a slight of I don't want to say sea change, but a slight change of thinking in terms of how they're looking at the credit from some of these AI companies. Because the whole idea is they're going to borrow an amazing amount of money because they need to invest in all these chips from NVIDIA, these crazy data centers. They're going to send them to the moon. They're going to do all kinds of nutty stuff with the billions of dollars they're going to get. And it's like, all right, well, how are you going to make money on this? Oh, don't worry. We're going to be drawing these pictures. It's going to look awesome. It's going to be great. And in 30 years, you're going to get your money back. So people are like, wait a second, 30 years, 20 years to get my money back on this huge investment now? Yeah. So I think that some of the valuation metrics are starting to come under closer scrutiny, at least in the bond market. And that's why I think you're seeing some of the CDS prices the price for protection rise a little bit. But again, we'll see how that plays out. I think there's been a little bit of a rotation rather from some of the Magnificent Seven tech stocks into some of the more non-techy things. But slow going.
We're getting macro we get here. But I love those kind of questions. All right, not much going on in rates, and that's the point, guys. That's not much going on in rates. I don't see much going on here unless some kind of crazy data point on jobs, which will push this to the left, or on inflation, which will push this to the right. We got to wait to see. That's really what's going on there. You got to push pull. We've talked about that on so many different occasions here. We'll skip a week there. I did this screenshot that's showing you what the market thinks the Fed's going to do. We just discussed that. Mortgage rates are probably going to settle in this channel. If I drew a line on top here and a line on the bottom here, it's just going to go up and down in this channel until, impacted by an outside force. It's like inertia. That's the right word,
right?
Inertia. Yeah, it's inertia.
Maybe that giant meteorite that's swinging by close to Earth is gonna
Atlas something 3i.
Atlas, yeah, yes, that one, the one that's changing color.
Yeah, changing color and tails, and people are like, wait a second, maybe it's not a comet. Ooh, we need like a Mulder, a Mulder clip. All right, guys, I want to go to some national housing. This is just some information that you guys need to know. It's not critical, of course, but it's like, we like to look what's going on in the national housing market. This is from our friends at Resi Club, mortgage-free homeowners in 2024. Are you not surprised what one of the biggest dark blue bubbles on this map represents? Just take.
Well, first of all, I don't know how to get a free mortgage, but I'd love one. But yeah. What's interesting to me is that I'm surprised at how many of the darker bubbles are in the South, because I would think with that massive wave of construction and financing, that would be basically all yellow. But it's not. It's dark. I'm looking at Miami. I'm looking at Florida. These are stable markets. So there's all that talk about the supply overhang. There's all that talk about how the developers are cutting prices actually, at or below the resale level. But you think about how many people, how much equity is there. It's less crash worthy than you think. And it's one of those things. No, I don't know. You may every once in a while go to YouTube and like search real estate or something like this on YouTube. I don't know what your YouTube searches look like, but sometimes you get these people like, there's a 50% price crash coming. Check it out. Watch my, rage bait video. So
I was told to do that after the pandemic, by the way. I was told I was criticized by someone by saying your titles are not engagement bait and click ragey enough. I'm like, well, I don't believe that we're going to fall 50%. Yeah. But yeah, I know what you're saying.
This would argue otherwise. I mean, you've got more than 50% of these people don't have a mortgage. I mean, there's no panic there.
Everyone's looking at housing. A lot of people looking at housing as going to be the driver, because that's what happened last time, with the great financial crisis. And I just don't think it's going to be housing. If anything, it's going to be the AI and the data centers and all the crazy things that are going on over there, and whatever network and systemic things that are going on in that sector. I don't know. We'll see. But anyway, mortgage free. That's interesting. I got to make this bigger, guys. I don't make these charts. Okay, and they're all different formats, different sizes. I got to resize them. Okay, we're trying to make this bigger. I apologize if it's blurry, but this is what it is. Single family housing permits authorized per 1,000 residents over the past 12 months across the country. These are the only couple slides I have on national. Do you notice the brown and where the brown concentration is over here? The dots, that brown represents low on this scale right over there. There's just not a lot of building.
Yeah, and it's the same in California along the West Coast as is it on the Northeast. And in Chicago, a lot of the major urban centers are just brown. But again, you look at some of the South and Southwestern ones, right? There's different. There's actually a lot of construction happening, a lot of permits. So look, this housing market is, I don't think it's as dire as some of the headlines would suggest.
No, well, there's pain going on in some markets, but like, guys, we are, in case you got someone that just doesn't believe, why invest in New York City? And structurally speaking, I mean, I'm not saying that this is a market that you're going to expect to 2x your investment, but structurally speaking, there's not a lot of development going on, and there's a lot of wealth. Let me go back. It's just what I gotta do. It's a lot of wealth. That's what this shows. A lot of wealth and not a lot of development.
Yeah.
So. Okay. Final chart, guys, and then we're gonna let you be, unless you got questions, guys. Unless you got questions, totally fine. If you guys want to leave early, start your holiday early. I get it. We talked about this on Friday. The age of inventory in Manhattan and Brooklyn, both under 100. I guess that's good, right? But Brooklyn's going up, Manhattan's going down a little bit, but Brooklyn's got an edge. They got a little fresher inventory set than Manhattan.
Yeah.
Closing the gap, though.
It's a very seasonal thing, right? As soon as you have that flood of new inventory in the spring, a little bit in the fall, that's going to push this number down, right? Because you have more fresh stuff. The key is how does it age? And so you can see the Manhattan line. I'm just going to refer to Manhattan here. The Manhattan line fell sharply in the spring, and this is 2025 lines here. So the 25 line goes down, and then it like holds its own. It's actually below Brooklyn for a while, which is a real testament to Manhattan. So good job, Manhattan. Brooklyn Brooklyn just doesn't have enough supply in general. And even though supply is higher than it's been, it's still low. But Manhattan rebounded up and then kind of came back down in the fall. And it's neck and neck with Brooklyn here. So this, to me, both of these lines suggest fairly healthy markets, even though, especially in Brooklyn, you haven't seen a lot of the demand that you would normally see or you would expect to see in Brooklyn. It hasn't really had that.
It's strange to have a tight market and a challenging market at the same time.
Yes, and I think that's the key here. And we've talked about how supply is really the unsung hero of both of these markets to kind of keep that demand level in check in terms of, if there's a glut of supply, that's when you start seeing things start breaking. But supply, you haven't had that glut. And so I think that's what we're seeing here. And so think about what we talked about at the very beginning of the show, right? A lot of that anecdotal evidence coming in that there's some good pipeline activity. We haven't necessarily heard that from Brooklyn, although it's very lily pad-ish. You have one townhouse up in Prospect Heights is doing fantastic, and then a condo in Park Slope might not be doing as good, or whatever it is. But there's different areas, different prop types are doing different things in Brooklyn. That being said, with that anecdotal evidence, looking where these lines are, this to me, it's sort of a green shoot for the spring. At least to me, it looks like it's setting up a very good spring season. I'm going to touch wood, salt over the shoulder, everything for that.
It'll be lovely just to see a couple of seasons. I want to see a spring and a fall, great for 2 or 3 years straight. That's what we need in this market.
Yeah.
But you know what? The market does what the market wants when the market wants to do it, Johnny. And all we can do is analyze, track, and interpret and advise. So that's what we're going to do, guys. We'll stick to what we do best over here. I just want to give you guys a couple of reminders. Tomorrow, price cut, price reduction strategies. That's tomorrow. If you need a price cut, we're going to learn how to do that tomorrow. We have one more session before the year's over on December 30th. I don't know if anyone's going to be around, but you guys asked us to do a year-end review. I put the order in to my engineers to get me the data for the year-end review. We'll put together a whole slide deck and show you how 2025 is done when you look at the whole aggregate of the year versus, I don't know, the last 10 years, I'll probably go, 2015, and we'll see how we've done. Outside of that, that's all I got.
Well, I have a comment here from earlier. It basically says,
yes,
waiting over a month for a contract to get signed, seeing some delays in all deals. So timelines are not always representing when deals are actually crafted.
Yep,
that's true.
That's true. That's true.
So,
all right.
When we, just as a quick aside, when we're looking at that, the chart, when you talked about the prices, where the prices are now and what section of the liquidity chart those are representing, one of the things that we were looking at right before that is, well, how long on average does it take a deal to go from contract signed to closed? And if you're interested, the median right now is, what did I say now? It's like 60 days, more or less.
60 days. Yep.
Sometimes it goes higher, sometimes it goes down, but it's about 2 months in general. So
look at this question. I love this question. With higher rates, flat resale values, buying makes little financial sense over renting. How do I overcome this objection with analytical clients? I mean, this is the tricky part. This is the hard part, guys. That's the thing. The rental market, there's still a gap. You're renting, it's there, here. You're buying, it's here. How do you? And this is the whole thesis behind Noam Newman's. It's the rental market's time now, and it's going to continue to be the rental market until the rent inches its way up to there. And that's when the sales market will make the next move higher. It's an interesting thesis. We have it on YouTube. I don't know if I can find the link before this show's over. John, could you maybe look for that? The Noam Newman, the New York City investment thesis, and post it here. How do you deal with that? I hit it straight on and just tell it like it is, right? This market has not gone anywhere. We're not going down. Show them the inventory charts. Show them some of the charts that we showed over here structurally from a regional perspective, right? Look how there's no development going on in this region. Look at the wealth that this market absorbs and brings in, right? It's just managing expectations. If you're looking to buy a New York City investment a property and 2 exit or 3 exit in 5 years, that's not what this market is. Okay. So you have to build equity, do the rentals, build equity over time if you can. And hopefully over time, if you're renting, right, over a 10-year period, then you stop renting and you're buying over a 10-year period, usually that it works out with all the deductions and benefits there.
Yeah, look, in many, you're absolutely right.
Great
Like in many cases, if you're just looking at the dollars and cents, it might not make sense to rent, because even though the rental price is probably going to be higher than the owning price on a monthly basis, even including, especially if you're in a co-op, just that overall money down, time, the time cost of money, et cetera, is going to be in renting's favor. That's, in many questions, there's no doubt about it. Owning is more expensive. I guess you have to start looking at some of the other non-tangibles, right? And the idea is that when you own, you can obviously, customize and do the places you like. To me, like that's a big thing. So some people like that. It's also sometimes you have better locations, but you're right. It's not as clear cut as we'd like it to be, and that's one of the reasons why affordability comes into play. And we'd like to see rates get back down under 5. That's the mythical number, that are under 6 rather. That's sort of what is a lot of economists are suggesting would sort of, ignite the mortgage market. But yeah, until affordability becomes, to your point, Noah, once those rents are probably more likely going to increase, right? We had the Fair Act passed. That kind of changed the mechanism of renting, but it didn't change the economics. The rents are high, and they're probably going higher. So
yeah, and I would suggest, listen, I just posted this YouTube in the chats. If you're interested in this topic, we sat down with Noam Newman for 45 minutes and discussed this exact thing and how he sees it playing out. And here's where we are in the process. And it's really interesting because the seeds of this situation that we're in right now were sowed years ago, if not decades ago. So he's like, to understand where you are today, you got to go back in time to this and understand what situations unfolded, mainly those rent regulations in 2019. Had a lot to do with where we are today and what's driving our market. Think about it from that perspective. It's all about intelligence, guys. And we'll try to bring in all these different people to tell them what they're really good at for this kind of thing. Noam is one of the good guys for the investment thesis. So that's why I wanted to talk about that. Okay. All right. Good question.
Speaking of legislation that's adverse to the housing market, I don't know if you guys are paying attention to Jason Haber. I suggest you go look for him. There's a COPA bill, which stands for the Community Opportunity to Purchase Act. I highly suggest you, if you're not familiar with that, you familiarize with yourself on that. It could be really detrimental to the multifamily market.
What's going on?
And the idea is if you've got an apartment building to sell, before you can actually put it on the market, you have to approach community advocacy boards, local boards, and say, well, I'm selling this. And they come up with a price, and you could say no, and then you market it, and then you find a buyer, and then you got to go back to them and say, well, here's the buyer I found. They can match your price. So it's interesting to say the least. So I highly suggest that if you're not familiar with it, and especially if you're dealing with rentals and you're dealing with landlords, this is something you should really be up to speed on. And Jason Haber, as always, does an amazing job at like making the stuff understandable and accessible. So
yeah, he's great with that.
I wish I had a link. I wish I could put a link up there. Like, you're good at those.
Maybe we'll work on something in the new year. We'll put something together to educate ourselves on that. All right. Thank you, John. Thank you, John. Thank you, Nick, for that. That was awesome. Thank you guys for being great this year. We love you. It's been a great year. Thank you for being loyal to Macro Monday. Have a wonderful, wonderful, safe, enjoyable, happy holidays with you and your family. Hopefully I'll see you tomorrow, and then we'll see you guys on December 30th. Cheers. God bless. Take care.
Thanks, everybody.
Bye, everybody.